Hey, what's going on, cash flow hackers? It's Chris with Life 180, and I got Todd and Kim here from Truth Concepts. And well, Kim, before I get it, we were just talking about where we're going to start with, but you just launched your new book, right?
Yes, Busting the Scarcity Mindset.
There we go. That's amazing. So I will put the link in the description. Anybody that wants that book, go get it. I also didn't tell you guys. Look at this. Look at this. Look at this.
Oh,
Congrats.
So I'm launching this in like 2 weeks. We just got, this is the demo, but it's, we had to make some updates. It's coming. It's going to be exciting. So by the time this video comes out, it's probably going to be launched. So I'll also put the link in the description below for the IUL Exposed book for anybody that wants that. And I'll send you guys a copy when it comes in. But so today we are talking about busting the greatest myth, I believe, in personal finance. And it's just my thing. But I think the greatest myth in personal finance is the younger you are, the more risk you can take. And I remember when it first hit me that this was a myth because of the fact that it just doesn't make any sense to me. And so I want to kind of like start off with this, and then you guys have this amazing software called Truth Concepts, and it speaks into the truth about the fact that money math and math are completely different things. And we teach people about money math. And when we talk about the younger you are, the more risk you can take, and that not making any sense, I kind of use this analogy of Tom Brady, right? Like when the Patriots, when you look at a football game, they start off and they script every play and they run and they have a strategy, right? And they take strategic, maybe strategic shots down the field. But for the most part, they're dinking, they're dunking, they're running the ball up the middle, they're doing their thing. It's not, they don't start throwing Hail Marys and really taking these really highly speculative plays until they're down by 7 points, 14 points in the fourth quarter, and they have desperation to go, right? Why is it in personal finance that people think that it's smart to not like game plan and script out our personal financial life and just start throwing Hail Marys right out of the gate, like that? But that's really what people are doing. And the reality is, the younger you are, the less risk you have to take because you got time and compounding on your side. And the one thing that, Warren Buffett always says is don't lose money. And so we want to make sure that we're putting ourselves in the best position possible to not lose money, to be able to build our foundation. And I just believe we got to save money with the intention of investing. And if we don't have that safe foundation, we're not really investors. We're just speculating because we can't afford to lose. And if we don't have the right savings. So financial structure is so important in the whole conversation and equation of building prosperity and building real wealth. And so I'm going to turn it over to you guys and like let you rip, because you guys got this whole sheet you just showed me that I'm excited for you to share and walk through with everybody.
yeah. And I think there's some real gems in what you just said, because this idea of risk, I don't think should ever be there, right? Why is, yes, nothing's set in stone, like you said earlier, but if you have the right things in place, you can get through the negatives so that in the end, it wasn't risky to make that step, right? And so if everything is strategized from the beginning, like you said, then we're not accepting an amount of risk, we're mitigating the risk. And I think there's a big difference there, right? And this idea that when you're young, you don't have to do it. And when does the Hail Mary come in football? Like you say, at the end, only because, and how often does it work? Like never. Like the percentage of that are down to nothing. So that's not a cure.
Todd, that's why I say to people, the real is, it shouldn't be the younger you are, the more risk you should take, the more risk you can take. It's the older you are, the closer you are to your goals, and the further away you are from your goals. Like the closer you are to retirement, the further away you are from your goals, the more risk you need to take, because you're desperate. You got to hit big wins. Otherwise, you're screwed, quite frankly.
Right. So, what we're going to look at is just exponential curve and just get an idea of what that looks like over time and how to shorten the time and what that changes. So just kind of an intro into the idea of what we're talking about here. So we're not going to get into the idea of how we're going to mitigate that risk necessarily or other things, but let's just look at time. And so here, if we look at just 4% net earnings, right? Most people, it's funny, younger people look at 4% net earnings as something that's, surely I could beat that, right? But people that are more experienced in the financial realm realize how valuable having a 4% net account that they can count on is, right?
Just be clear on that. 4% net earnings means net of taxes, expenses, fees, cost of insurance, all the other, anything else that would be involved, just for clarity for anybody who isn't familiar with that.
Yep. All right. So let's just look at this, and to kind of simplify, if we turn on cash flow 1 there, and we look at, if we had $26,110 every year for this 35-year time frame, we end up with $2 million here at age 69, right before 70, if we want to shift gears a little bit, start and move into the distribution phase. And so that $26,000 over that time frame, if we can do that every year with consistency, we end up with $2 million exactly at the end of that time frame. All right. So the question is, what happens if we get bogged down with other things, we don't get on this, and it's 12 years before we start this, right? Well, and actually, before we do that, let's look at this on a graph where we can kind of see what happens. So if you would pull up that side by side.
On which graph? Oh, Kim, you're talking to. Gotcha. I'm like, I don't see anything else to pull up for you, bro.
Yeah. And the chart. All right. So here we see our expenses across the bottom, or our payments into this 4% account. So we've got $26,000 every year, and that's using the values from the left side of the chart where it says cash flows over there. That's the amount of dollars for that. And then as far as our growth line there, it's using the information on the right hand side, and you can see it grows up to that $2 million. So we're putting that $26,000 a year in, and it grows to $2 million over that time frame based on 4% consistently every year after taxes and after fees.
Love it.
Okay. So now let's look at what would happen if we look at cash flow 2 and we stop, or we don't start actually until the 12th year there. So now that all of a sudden we're at 26,000, if we scroll down on this.
So what you're saying here is the importance of not waiting, the actual cost of waiting effectively.
Look what happens if we wait 12 years. So 12 out of the 35. So we basically only waited a third of the time frame, and look what happens. We end up with just a little over half of what we would have had otherwise.
So what are the total contributions in this one compared to the total contributions in the first version, in the first 913? So you basically only put in 300,000 more, but you get $1 million more.
Isn't that something?
Yeah, that's pretty cool.
So basically 2/3 of the money to get half of the account.
Yep.
Right?
Yeah, I know. Yeah.
And then if we look at that on a chart, back to kind of compare those two on our side by side.
For sure.
Then this is what it looks like. If we could catch up, but see, we can't. So what does it take to catch up to that $2 million? Look at that green line across the bottom, or those green bars. So we had to jump up to almost $50,000. Let's go back and look at our cash flow chart.
So you got to basically double your contribution.
Yeah. So this is what we would have to do instead. Turn off cash flow 1, Kim. But what has to happen here is now we have to put in $1,180,000 if we want to hit that same $2 million because we waited.
Right. Yep.
So the difference is $1.1 million versus what was that on the first one? No. $1,100,000, 620 versus 913.
913.
Yeah. Yeah. So you're putting in like $167,000 less.
And what it takes to catch up. What if we wanted to try to do this by just saying, okay, we can't do more than 26,000, but we're going to go and we're going to do some other investments on the side. How much would we have to dump into this account in that 12 years to get us to the end? So let's look at cash flow 3. All right. We'd have to dump in $366,000 to get to that $2 million.
Yeah.
Right.
That's not
so
good.
If we wait that 12 years and we want to stay on that same path, we either have to accelerate the amount of money going in after that, or have a huge lump sum to be able to go in there somewhere. And if we look at C, And this is what has to happen to make that happen,
Yes,
to get
you
back
gotta
on
do
that same
part
curve.
to catch up. Yeah.
Yeah.
Got it.
And so it's not about trying to push money at the end. We need to start now and be consistent. And I know for some people, they say, well, I should have started a long time ago, but it's the old, just when should you plant a tree, right?
Totally. Yeah. I always think about that, right? That just is what it is. We gotta plant a tree now or 30 years ago. But if you didn't do it 30 years ago, the next best time is now, right?
Right. And to get us back on the path. But the issue, and I think the risk that happens, is because people didn't start early, or because they think they can delay and do some other things first,
Yeah.
instead of combining some of that. Because many times that certainty feature that we talked about, the thing that mitigates risk, most people look at that as having a huge amount of cost, and it's because of the strategies that they have in place, right? It becomes pure insurance for some people, instead of integrating something that can add to both sides, not only give us the protection or the certainty, but maybe also add to our wealth. And most of the time people think about it as a detraction, right? If we mitigate risk, if we protect against the downside, then it's going to cost us money. But that's just because the wrong strategies are in place most of the time.
Totally. No, I mean that just it's so funny. This stuff is so once you understand it, once you see it, it's one of those things, you can't unsee it, and it's you realize like how much people are suffering unnecessarily, because I realized how much I was suffering unnecessarily early in my life because of just bad financial decisions, quite frankly. And it's just like, I mean, I was telling you guys before we got on, I was just doing this meeting with this 20-year-old kid who's got his whole life together, and he's making crazy income and doing awesome. And he's on the phone with like learning these strategies and doing all this stuff. And I'm like, man, what I would give to be able to go back to when I was 20, like to know this stuff when I was 20, you know what I mean? Like, oh my gosh. But so it's, the one thing I'll say though, when we start talking about this, I want to make this really clear too. This is just kind of my perspective. I don't know how you guys feel about this. Is like, I believe that at some point in time, you got to take risks, right? Like to make, I mean, you don't have to, but I'm a big believer, like maybe I like to take risks. I don't know. But like it's managing your risk, right? So to me, what I look at like this is taking risks when you can afford to take the risks, right? Like, and what that it looks like is the financial structure of your life. And it's kind of what I started with is if you are going out and just and taking these big swings and investing in Bitcoin, and it's not that any of these assets are bad, right? Because they're not. They could be really potentially good, but there is no good or bad asset. Is it good or bad for you? Is it the right fit for you? Is the risk in alignment with what your risk tolerance is? And I know that risk tolerance is this, like, I don't know, overly used phrase by financial advisors or planners at this point in time. The way I look at like what your risk tolerance is can you afford to lose it? Like I run everything through what's the upside, what's the downside, can I live with the downside, and the downside for most of these investments is it could go to zero, and I mean, there are certain companies that obviously that's not the case, but we've certainly seen the market lose 50%. And I don't think it's out of the realm of possibility that could happen again. And so once again, what is 50% horrible? Is it the end of the world for you? Well, it depends on your need for liquidity and your time frame that you're going to need to tap into that. And so making sure that your assets are built and your financial structure is built in accordance to that. And so when we look at something like this, I look at it as a foundational asset that we can build our expansive capacity off of, right? Because as we grow, as we are young and then we grow, we expand, our knowledge expands, the opportunities that we're looking for expand, our own abilities and capacities expand. And so therefore, the more we have in these accounts, this financial foundation that we have, the more our opportunity expands. Because I think it was Nelson Nash always said, the more money I have in my whole life policy, the more opportunity has a way of tracking me down, right? And so What do you guys think about all that?
What's up, cash flow hackers? I want to interrupt this video really quickly and let you know about something we have going on that's really exciting to me. It is our first major Life 180 event. It is the Life 180 Aligned Wealth Experience live in Scottsdale, Arizona, August 21st through August 23rd, where we are going to be changing the game in the life insurance space. So if you're an agent, if you're somebody who's looking to learn, kind of feel into, would this be good for you? Would these philosophies, these strategies be good for you? I'm going to be teaching. I've got other experts that are going to be coming in, teaching on the Rockefeller method, teaching on how to invest in real estate without being your own landlord, the highest level tax strategies, trust and estate planning strategies, all of these things, all the tools that the most successful people in the world utilize to get to where they want to go. This is what we're going to be covering in this. So it's going to be covering the whole cash flow hacking process. Have any questions, go in the link in the description below or go to life180.com/live2025. Check it out.
I think it's right on track. I think what you're talking about is the difference between opportunity and gambling.
Yeah,
See,
totally.
that to me is where risk fits in there. I don't think risk is necessarily bad, but if we don't have certainty assets in place to shore up what we know could be bad for a while, it just becomes gambling. I mean, you might as well just put it on red in Vegas, right? Instead of actually having some strategy around. And can you go to Vegas with a strategy and mitigate your downside loss? Are there plenty of people that actually make a living there? Right? Yeah, you do that, right? But do you do it because you just say, I bet this next card's going to be whatever, and I'm going to put everything on that? No, you have some strategy around it.
Yeah. Totally. I mean, I don't know. I don't know if you remember this or not, but I was a pro poker player for 7 years.
Yep.
So, people ask me what made me as good as I was, and I'll tell you this: it was bankroll management, being able to keep a steady head. And when the good happens, don't get too high. When the bad happens, don't get too low, and know how to manage your bankroll accordingly. That way, when the bad happens, you can weather the storm because it's inevitable that it's going to happen. Right. And so a lot of the principles that I learned about personal finance that I implement and coach and teach now, I learned as a professional poker player, which is kind of crazy when you think about it. I went from poker to life insurance, but I mean, hey, somebody's got to do it. So but it's, I think that's the key. I always say, I love how you brought gambling into it, but I call it's speculating versus investing, right? Like people think they're investing, but you're not. If you don't have a financial foundation built, you're not investing, you're speculating. And you may get lucky, you may win, whatever. But Todd, Kim, and I are not in the game of like showing you how you might be able to win. We're here to show you how you can win predictably 100% of the time, every time, if you just do what you need to do. Like, that's it.
Yeah, luck is almost a downside, right?
Yeah.
How many people like go to Vegas and if they had lost, they would be way better off.
Oh my gosh. Yeah. I mean, like, oh my God. I have so many stories.
Well, it'll be interesting as we take this next step and look at what are the potentials that everybody's thinking about all the time and what does that look like and what does it actually do. Before you head there, Todd, I think another analogy that helps people a lot, and we keep using the analogy of the foundation, is if you want to build a 10-story building of your personal wealth, your foundation is going to look different than if you just want a 2-story house. Totally. And so that foundation, the strength of that foundation is critical. And it all comes back to cash and liquidity, which are monies necessary to solve emergencies and take advantage of opportunities. That is the foundation of your wealth. And so that is the kind of money that must sit at that 4%, give or take. And we know the spaces where that money can sit to solve emergencies and take advantage of opportunities. But Todd, let's go ahead and look at what might be the upside potential that everybody thinks is there.
Yeah. And so often when people get into this secondary position, we waited too long, we didn't have money. So now, we've decided we can't afford to build this foundation. So what we have to do is go to the marketplace, and because for some reason, the market's going to save us, right? Because we know it's done 12% over the last 40 years or whatever that is. But it's interesting when we actually look at it and what those additional ripples are that go along with it. Because remember what we were talking about here was a 4% net after taxes and fees account, right? All right. So let's go to the market for just a minute. So let's go and we're going to look and we're going to use, arguably the best of the best, the S&P with dividends. So if we go look at the market, so go ahead and pull up a market history. And so I'm going to use the S&P, but let's go, our time frame here was 35 years. So let's go and change that 124 to 35 years. And if we look at the S&P with dividends right there close to the middle, what we see is an average of 12.01% over that time frame. Now, one thing that gets kind of confusing is everybody talks in averages in the financial industry, but those ups and downs don't really allow us to take advantage of the average. It's not the same as 12% every year. And so it gets a little confusing, and we can play with that just a little bit and see, like if we had lump sum in there, what does that do if we just put money in up front? So just put $1 up there on present value. Just a second, Kim, we'll just educate a little bit. And what we see is, well, rather than 12.01 every year, it did the effective return if all we did was put money in one time of 10.53, or if instead of that, we did the dollar cost averaging of putting money in every single year, it's 10.46. And we can look at that and say, well, that's not that big of a deal. But actually, just quickly, Kim, if you just get me a future value calculator, this is kind of a shock, I think. And if we just put, just to keep it simple, let's just put $10,000 a year in for 35 years at 12.01%. And what we see is $4.8 million, okay? But now then, give me a second calculator, and let's put that same $10,000 a year in at 10.46, which most people would say, well, that's not that big a deal. It's only a 1.5 difference, right? Yeah, that's $1.5 million difference.
$1.5 million.
Yeah.
Just that.
Just for that little bit. And that's before taxes or fees or anything else. So, people throw numbers around there like it's a given. And we hear that from, Dave Ramsey and everybody. And that's not that easy to get to. And there's other things that come along with it. So that's what we're going to kind of look at. So,
and that's during like some of the greatest return periods in the history of the S&P.
Oh, yeah.
I mean, like, I do a video, I don't want to sidetrack, but like I did a video where I talked about if you eliminate the average returns of the S&P 500 from 1980 to 1999, and then you take the average return of the S&P 500 for every other year, and with eliminating 1981 through 1999, that 2-decade window, the average rate of return of the S&P drops by like 4.5%. It's crazy.
Yeah. And what's interesting is that time frame. A lot of people say, well, you can't just drop that. That's part of what happened. Yeah, but what is it that caused those crazy returns during that time frame?
A crazy increase in the federal funds rate, reducing interest rates, money going into 401ks for the first time, qualified plans being created. All these things all happened at this 1979 to 1981 window where it got crazy. And so, and I'm just a big believer that when you at that point in time went from a 19% federal funds rate all the way down to 0 in 2009, and then had quantitative easing, like that does nothing but just stimulate investment and asset prices and all those things. And so I think we have to eliminate that. People say you can't, you shouldn't, because that's part of the story. I think you almost have to, because unless we're going to repeat that environment, which I don't ever see a world where we can at this point in time without complete financial overhaul as a nation and as a world. I don't see how we can repeat that. So I think we have, from a planning perspective, I feel like we have an obligation to eliminate those 2 decades.
Yeah, what's interesting is during that time frame, a lot of the companies inside of the S&P and inside of the Dow were not even making profits, certainly not significant profits. So you say, well, wait a second, how did the market climb like that? And yet the companies underlying those indexes were not making any money. And the reason is it was just the volume of money that was going through. Like you say, the big one being the 401k. So, I guess in theory they could open up another loophole, tax loophole, I guess is what a lot of people call the 401k, but a tax advantage account that would cause that kind of jump. But I don't know what that would be or how.
No, I don't think so, because back then it went from nobody was invested in the market, right? No, like it was only a very small percentage of the population that was investing, whether it was mutual funds or qualified plans or whatever. Qualified plans just created accessibility. And so now with Robinhood and investment accounts, like even without qualified accounts, everybody's got the access. That just happened to be the gateway where it kind of started. And, that 2-decade window, it was the floodgates opening. And so now all the metrics are completely different. All the like PE ratios that are considered safe and healthy and good are way different than they were in 1975, right? Like just because it's just a different environment. And so, and that's fine. There's nothing necessarily inherently wrong with that. What's wrong with that is the manipulative tactics used by sales advisors, financial salespeople, to separate people from their money, to get them invested in managed money accounts where you pay 1% to 2% annual fees, and the financial advisors annuitizing your portfolio for their own income.
Yeah. And those previous rates are influencing what people can talk about as the average across a long period of time, right? As part of those sales tactics. But the other part of it is people don't realize when they make that decision, there's ripples around every decision that we make financially, because we live in a world where we have a finite amount of money, right? Every decision is push and pull. The only way we can do money here is because we're not doing money somewhere else, or vice versa. And we forget about those ripples. And we look at the market, some of those ripples are pretty big. If we follow modern portfolio theory, which is what most advisors have to follow, and that is to have a certainty asset, or what we thought was a non-correlated asset for many years. The bonds turns out to be a little more correlated than they were supposed to be, right? But bonds is typically that non-correlated asset that has to be part of the portfolio. But since it's such an anchor on the overall growth, most of the time they just ignore that piece, right? We only look at the winner. We only look at the big one. But if we incorporate that into the conversation, it looks dramatically different, especially when we add the taxes and fees. So let's do that. Let's use this great return of the S&P with dividends, but let's share and do 60% of that and 40% on bonds for that certainty, supposedly uncorrelated asset, right? And so if we switch that to a 60-40 mix and use the two best over that time frame, the S&P with dividends and the Dow Jones Composite Bond Index. All right. And let's also put some taxes and fees in there. So if we put taxes and a lot of the S&P, if they're directly in the S&P, could be deferred on the tax. So I'm just going to use a 10% rate there on taxes, because not all of it's going to be taxable each year. And then on the Dow Jones Composite Bond Index, we'll use 22% there. And then on fees, I'm going to be really low on that on the S&P side. Let's just use a 0.5 point there, and let's use 1.5 points on bonds.
Okay.
All right. And so now what we see on the far right column, this is a combination of all of that, the 60-40 split with bonds and equities, as well as the taxes and fees on that. And we see that drops to about 6.72. So let's copy that. And let's go over to our cash flow calculator and put that in.
You know what I love about this is that my audience is nerdy enough to love this.
What was that?
I said, I think the thing I love about this the most is that my audience is just nerdy enough to love this content.
Yeah. So here's where we were earlier with our 4% and stopping for 12 years, but now we're in catch-up mode. So we think the S&P is going to fix it. So let's just paste these returns in here over the last 35 years. And we didn't get to take advantage of the first 12, right? So we're looking at the end, and look at what we end up with.
What do we got?
1.5 million, not anywhere close to our 2 million.
Nowhere near. Yep.
And if we don't do as well as the S&P did this last, whatever that 24 years,
yeah,
then it's even worse than that. And those are some pretty big returns in there. But when we look at all those ripples, is it really doing that much more than just 4%?
Yeah, no, it's not. And when you think about the risks that you're taking, and you think about the fact that it could be worse than that, right? Like, I mean, that's during that period of time. And yeah, I mean, I don't want to go down too far of a sidetrack, but like, I'm not a market guy. You know what I mean? Although I will say today that we're recording this, I do invest in 2 stocks, and my portfolio went up 36% today. So that is like, I'm not even going to talk about what I'm investing in, but it was pretty awesome. But once again, totally speculative thing that happened to work out, you know, and I could do it because I don't need it to win, right? If it went down 36%, it's not going to change my life either. And so it's just kind of a fun thing. But aside from like 4 stocks that I'm totally like, I call it speculating in, but it's like a long-term hope they work out kind of situation, where I'm kind of gambling on it, but I'm gambling because like I can, you know what I mean?
Well, it's not really gambling at that point, right? It's opportunity, because it's covered elsewhere.
Yeah, exactly. And it's kind of a fun speculative type investment that I'm doing. But this is why I just love the power of whole life insurance. And when we look at what you're talking about, and I think it's so important because of the fact that when you look at what you're talking about and you realize like, wow, on a net basis, whole life insurance really doesn't trail by that much. And when you look at the certainty that it provides, when you look at the opportunity it provides, when you look at the benefits it provides, I look at whole life, I just had this conversation with this kid. Whole life insurance becomes your financial efficiency filter, right? Because it's beyond what are the returns. Because if we look in our life and we say, all right, it's not just about what our assets do for us, what our investments do for us. It's like, what do my car loans cost me? What does my mortgage cost me? What is like all the cash flow that goes through my life? If I could be more efficient with every dollar that flows through my life and stop worrying as much about investing and trying to take a little bit of my portfolio and taking massive returns with that, ending up exactly where Todd is showing you, what would it be like if you could do what we're talking about, utilize whole life insurance, get almost to the same, like further ahead potentially, but like with whole life insurance, with all the certainty, and have that asset there to help you expand and have that expansion capacity and create more opportunity and become who you need to become to create the life that you want to live.
Yeah. Yeah. It's, and the thing that's not even talked about this, I would argue that over a long period of time, which is what a lot of the discussion is around the market, that the market is going to perform, on a pretty average amount. I mean, it's going to do okay long term. The issue is with that sequencing, when is it you need the money? See, that totally derails the long term or average returns that you're getting. If you got into this when, and you happen to hit it exactly the right spot, it would be great. If I hit it right when it was doing 20% and I pulled out right before it dropped, okay, we don't have a crystal ball. So the issue is that sequencing returns and the way it fits in our life is going to totally change how that actually rewards us on the investment side. And so, we don't know when that is we're going to need the dollars. And if we're forced to take it from the account when it's not a good time to take it, it's going to dramatically impact the amount of money we have. And that's what's great about having that, a real certainty asset on the side, like life insurance, that we could lean on during those down times and actually make the returns in our investments do what they're supposed to do without being impacted by that sequencing.
Love it.
Todd, do you have one more graph that you want to show?
Sure. We could look at this on the graph. If you want to look at that other side by side, just okay. So basically, if we started like we knew we should with our $26,000 a year, earning a nice 4% consistent return,
sure.
Versus saying, we're going to wait 12 years, and now then we have this green line going all over the board that doesn't catch up, is still $500,000 short. And that's where I think a lot of people are. If they're, if they don't end up with a big down year. I mean, look at what happened at age 65. I'm sure that was a little panicky, or 67 when we saw that massive drop where the account lost a ton right there. What if that was when you wanted to retire?
Right. I mean, and at the end of the day, this assumes that your investor behavior is going to be on point, right? Most people do not perform. Their portfolios don't perform as well as the S&P. That's just the reality. Like, be Debbie Downer here, but that's just the reality.
Yep. Emotion gets involved, and we get outside of the strategy, right? For sure. And it usually happens in times like you have there at, age 65 and 67 right there. Yep.
Right. So that just is what it is. And if you needed that at that point in time, that wouldn't necessarily even be bad behavior. It would just be a bad circumstance that you need the money in that year, like it's just unfortunate for you. Or maybe you just don't get to touch the money. Maybe you have to work longer. Maybe, you put your retirement plans on pause. That might be it too.
Well, and that would be better than taking the money right there if you had that option. And that's what I think people don't understand. During the accumulation phase, the ups and downs aren't as bad as they are when you're in the distribution phase. Now the downs really hurt because, like you're saying there, at 67 when that dropped, if you made distributions there, it's not still in the market to be able to take advantage of when the market turns around and goes back up. Now you've turned paper losses into real losses.
Yep. I love it. This is good stuff, man.
Yeah, it's really interesting some of the things that are out there and some of the things that we hear when just a good foundation and a good strategy on somebody's entire financial world is what they really need to do so that they're going forward. And it all goes back to what you were talking about with Tom Brady, right? It's having a good strategy in place with the flexibility to adjust because the financial environment is not going to be